In the unpredictable realm of trading, anything can happen. Yet, with the right approach, you can navigate these waters with confidence and resilience. We'll delve into the 7 principles of consistency, guiding principles that can help you trade more effectively. Intrigued? Ready to delve into these principles? Let's begin. The first principle is having an edge with positive expectancy. This principle is all about your trading strategy offering a statistical advantage over time. It's just like playing poker with a favorable hand. You may not win every round, but over a series of hands, you're more likely to come out on top. The same applies to trading. Maybe you've developed a strategy that gives you a slight edge in predicting stock movements. This could be through technical analysis, fundamental analysis, or a combination of both. It doesn't guarantee you'll win every trade. In fact, you'll definitely experience losses. But that's okay, because remember, you're playing the long game here. With your edge, over a series of trades, you're positioned to be profitable. It's not about winning every single time, it's about winning more often than not. With this edge, you're likely to emerge profitable over numerous trades, despite occasional losses. The second principle is thinking in terms of risk-to-reward ratios. You see, every trade is a gamble, and like any gamble, we seek to maximize our potential winnings while minimizing our potential losses. This is where risk-to-reward ratios come into play. It's really a simple concept. You're measuring the potential profit of a trade against the potential loss. Let's conjure up a scenario to illustrate this. Imagine you've caught sight of a trading opportunity. You stand to make a $200 profit per share if things go your way, but if they don't, you could lose $100 per share. So your risk-to-reward ratio here is 2:1. You're risking $1 with the possibility of making 2. This is a favorable ratio, as the potential reward outweighs the risk. In essence, thinking in risk-to-reward ratios helps you make calculated decisions in your trading journey. Always aim for a favorable risk-to-reward ratio. The third principle is acting on your edges without hesitation or reservation. This principle is pivotal in effective trading. Once you've identified an edge in the market, decisive action is key. Let's paint a picture. Imagine you've been meticulously analyzing a particular stock. Your research has paid off, and you've spotted a potential breakout. Now this is the moment where hesitation can be your worst enemy. It's like standing on the edge of a cliff, contemplating whether to jump into the crystal clear water below. You know it's safe, you've done your checks, but that little bit of uncertainty nags at you. In trading, just like cliff jumping, you need to trust your preparation and take the leap. Execute the trade promptly and confidently. Stick to your strategy. Remember, you've done the groundwork, you've identified the opportunity, and now it's time to act. Once you've identified an opportunity, act promptly and confidently. The fourth principle is predefining your risk before entering a trade. This principle is all about taking control of your emotions before you even hit the buy button. Let's imagine a scenario. You've decided to purchase a stock at $50 per share, but before you commit, you establish a risk limit of $5 per share. This means if the stock price falls to $45, you exit the trade. This prior decision helps you manage emotional decision-making during the trade. You see, markets can stir up a whirlwind of emotions, and these emotions can cloud your judgment, leading to impulsive decisions. By predefining your risk, you set a clear line in the sand, a point where you say, enough is enough. It's a safety net that catches you when the market doesn't swing your way. Predefine your risk to keep your emotions in check. The fifth principle is letting go of needing to know what will happen next. This principle is a cornerstone of trading. Because let's face it, the market is a whirlwind of unpredictability. In this dynamic environment, it's essential to accept that we can't always foresee what's around the corner. Take for example a scenario where unexpected news triggers a sudden stock price drop. Your instinct might be to panic, to question your strategy, to second-guess your decisions, but that's where this principle comes in. Rather than succumbing to fear, you adhere to your risk management rules. You trust the strategy that you've honed over time. You acknowledge that while you can't predict every market movement, you can control your reactions, you can manage your risk. It's about trading with discipline, even when the market throws a curveball. And that, my friends, is the power of letting go. Embrace uncertainty and focus on risk management. The sixth principle is thinking in terms of probabilities. In the world of trading, it's crucial to understand that every decision made, every trade executed, is a game of chance. This doesn't mean that trading is akin to gambling, not at all. It merely underscores the importance of acknowledging that each trade is a probabilistic outcome. Let's illustrate this with a scenario. Say, your trading strategy has a 60% win rate. This doesn't guarantee success in every trade. Instead, it suggests that over time you're more likely to win 6 out of every 10 trades. Despite the outcome of individual trades, it's the long-term probabilities that truly matter. The key is to focus on the bigger picture, to not get swayed by short-term fluctuations. Remember, it's about consistently sticking to your strategy, to your edge, because that's what favors profitability over time. So in essence, every trade is a probabilistic outcome. The seventh and final principle is trading to trade well, not for the money. In the whirlwind of market volatility, it's easy to become fixated on profits. However, the true mark of a seasoned trader lies not in the pursuit of monetary gain, but in the mastery of trading itself. It's about honing your skills, refining your strategies, and embracing the continuous learning curve that trading presents. The profits? They're merely a byproduct of trading well. It's imperative to remember that each trade is an opportunity to improve, to learn, and to grow as a trader. Prioritize your trading proficiency over immediate profits. Strive for consistency in your trading approach, regardless of the market's ups and downs. Don't let the allure of quick profits cloud your judgment or compromise your strategy. In a nutshell, the real reward in trading is the journey, not the destination. Focus on consistent adherence to your plan. That's how you truly win in trading. These principles guide you through the unpredictable realm of trading. We've journeyed through the dynamic world of trading today, focusing on 7 core principles that, when implemented, can help ensure consistent success. These principles aren't just strategies, they're a mindset, a way of thinking that can guide you through the tumultuous terrain of the market.